There is a secret language spoken by the world's most successful capital allocators, a dialect of discipline that sounds like silence. It's a language in which the most powerful word is no, and the most profitable sentence is, "I'll wait." While the rest of the world is caught in a frantic storm of activity, a manic dance of buying and selling, reacting to every headline and every flicker on the screen, these masters of the long game are sitting still. They are not trading, they are hunting. They understand that in the grand arena of the stock market, hyperactivity is a tax on returns, and constant motion is the enemy of wealth. The broker, the financial news network, the trading app on your phone, they all have a vested interest in your activity. Your clicks, your commissions, your emotional reactions are their revenue streams. But the greatest market edge, the one that truly separates the generational wealth builders from the crowd, is the ability to do nothing. To sit for months, even years, with a mountain of cash, observing, analyzing, and waiting for the one perfect moment when the odds are so overwhelmingly in your favor that the decision becomes obvious. This is not laziness, it is the highest form of investment discipline. This is the art of patience, the billionaire waiting game that guarantees a portfolio of better stocks, better businesses, and ultimately a better financial future. We are about to deconstruct the core philosophy of the most successful investor in history, Warren Buffett, through his most powerful analogy, the fat pitch. Imagine yourself as a batter in a baseball game. But this is a peculiar game. There are no called strikes. You can stand at the plate all day, and the pitcher can throw thousands of balls, high, low, inside, outside. You are under no obligation to swing. You can watch 100 pitches, 1,000 pitches, go by. Your one and only job is to wait for that one perfect throw, the one that comes in slow, right over the heart of the plate, the one you know you can hit out of the park. In investing, this is the fat pitch. It is the rare, high-probability, no-brainer opportunity. The market will throw thousands of companies at you every day, overpriced glamour stocks, complex biotechnologies, speculative commodities. These are the curveballs in the dirt. The discipline is not in swinging at them and hoping to get lucky. The discipline is in letting them go by. This journey we are embarking on will rewire your entire approach to the market. It is designed for every investor who has ever felt the anxious pressure to do something with their money, who has bought a stock out of boredom or sold one out of fear. We will dissect the psychological traps that lead to costly action and build the mental fortitude to resist them. You will learn to stop chasing mediocre ideas and start building a portfolio based on a few, truly exceptional decisions. This is not just another piece of Warren Buffett advice. This is a blueprint for transforming your patience into your most profitable asset. We will build this understanding from the ground up, constructing a fortress of reason around 5 fundamental pillars that uphold this entire philosophy. Each pillar is a step away from the path of the 99% and a step toward the mindset of a true professional capital allocator. We begin with the most crucial foundation of all, knowing what game you're even playing. You cannot wait for a fat pitch if you don't even know where your strike zone is. The first pillar of this entire philosophy, the bedrock upon which all profitable patience is built, is the meticulous and honest definition of your own strike zone. In investing terms, this is what Charlie Munger, Buffett's longtime partner, calls the circle of competence. The fat pitch is a relative concept. A pitch that is a juicy, slow-moving softball to a biotechnology PhD might be an unhittable, invisible blur to a banker. And a complex derivative that seems obvious to a Wall Street quant might as well be a foreign language to a retail expert. Buffett's genius is not that he knows everything, it is that he knows precisely what he doesn't know. He waits for pitches not in the market's strike zone, but in his own. He waits for opportunities in simple, understandable businesses whose futures he can reasonably predict. The discipline of waiting is meaningless without the clarity of knowing what you are waiting for. This is the first and most profound separation between the professional and the amateur. The amateur swings at everything that looks exciting. The professional waits for the one thing they understand better than almost anyone else. To truly grasp this concept, we must travel back in time to 1972. Warren Buffett and Charlie Munger were presented with an opportunity that would become a defining lesson in their careers, and a perfect illustration of the circle of competence. The opportunity was See's Candies, a beloved family-owned chocolate company based in California. On the surface, it seemed unexciting. It wasn't a hot new technology. It wasn't a complex financial instrument. It was just chocolate. But for Buffett, it was a pitch floating right over the center of the plate. The See family wanted to sell the business, asking for $30 million. The company was earning about $2 million after tax, meaning the asking price was 15 times earnings. By the quantitative, deep value metrics Buffett had learned from his mentor Benjamin Graham, this was expensive. Graham's method was to buy cigar butts, mediocre companies at dirt cheap prices, offering one last free puff. See's was no cigar butt. It was a premium brand being sold at what seemed like a premium price. Buffett's initial analysis showed the company had about $8 million in tangible assets, things like factories, inventory, and cash. The $30 million asking price meant they would be paying a $22 million premium for something that didn't appear on the balance sheet. Goodwill, the power of the brand. Buffett, the disciplined student of Graham, almost walked away. It was Charlie Munger who pushed him. Munger argued that they were not just buying assets, they were buying an economic franchise, a business with a durable competitive advantage. This is where the circle of competence became so critical. Buffett didn't understand software or pharmaceuticals, but he understood this. He understood the customer loyalty that See's commanded. He understood that people would walk into a See's shop at Christmas and happily pay a premium for a box of chocolates, without even checking the price of a competitor like Russell Stover. They weren't just buying candy. They were buying nostalgia, tradition, and a guarantee of quality. This unquantifiable feeling was a powerful economic moat. Buffett and Munger could visualize the company's future with a clarity they could never have with, say, a semiconductor company. They could see that the minimal need for new capital investment, combined with the brand's pricing power, would allow the business to gush cash year after year. They could raise prices to match inflation, and their loyal customers would barely notice. This wasn't a complex calculation involving beta or advanced calculus. It was a simple observation about human behavior and brand loyalty. It was inside their circle. So they overcame their initial hesitation and paid the $30 million. That decision, to buy a wonderful company at a fair price rather than a fair company at a wonderful price, was a pivotal moment for Berkshire Hathaway. Since that purchase in 1972, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire, all while requiring very little additional capital investment. That initial $30 million check has been returned more than 66 times over. The profits from See's provided the capital for countless other investments. It was a gusher of cash that funded the growth of their empire. This entire financial victory was born from one simple fact: they understood the business. They knew its strengths, its customers, its economic characteristics. It was a fat pitch, but only because they had spent a lifetime studying that specific type of pitch. They had the discipline to let thousands of other, seemingly more exciting opportunities go by, because those were outside their circle of competence. See's Candies wasn't just a good investment. It was the physical manifestation of knowing your strike zone and swinging with conviction only when the ball enters it. The psychological principle that makes the circle of competence so potent is its direct opposition to one of the most pervasive and dangerous cognitive biases in human decision-making: the Dunning-Kruger effect. Coined in 1999 by psychologists David Dunning and Justin Kruger, this bias describes a phenomenon where individuals with low ability at a task overestimate their own ability. In essence, the less you know about something, the less equipped you are to recognize your own incompetence. It's the mountain of ignorance that fuels the peak of Mount Stupid on the Dunning-Kruger graph, where confidence soars far beyond actual competence. In the world of investing, this is a weapon of mass financial destruction. The retail investor who reads a few articles about artificial intelligence suddenly believes they are qualified to pick the winning AI stock. The executive who has success in one industry assumes that success will automatically translate to an entirely different market. They are swinging at pitches they can't even see, armed with a blinding overconfidence. Warren Buffett's entire philosophy is a conscious and deliberate war against the Dunning-Kruger effect. The circle of competence is not an arrogant declaration of what he knows. It is a humble and brutally honest admission of what he does not. He famously avoided the tech bubble of the late 1990s, not because he was certain it would crash, but because he admitted, publicly and repeatedly, that he did not understand the business models of these companies. He could not, with any reasonable degree of certainty, project their cash flows 10 or 20 years into the future, while others, buoyed by the Dunning-Kruger effect, saw themselves as tech visionaries. Buffett saw himself as an outsider looking in. He felt no compulsion to play a game where he did not understand the rules. This is a profound act of intellectual humility. It requires you to silence your ego, the part of your brain that wants to be seen as smart and informed on every topic. It demands that you be comfortable saying, "I don't know," which is perhaps the three most powerful words in any investor's vocabulary. This mental discipline works on a cerebral level by creating a filter. When you have a clearly defined circle of competence, you automatically discard 99% of the information and opportunities the market throws at you. The noise simply doesn't register. The endless chatter on financial news about a hot biotech stock is irrelevant if biotechnology is outside your circle. The speculative frenzy around a new cryptocurrency is just background noise if you haven't done the work to understand the underlying technology and its economic utility. This filtering mechanism conserves your most valuable resources, your time and your mental energy. Instead of spreading your attention thinly across 1,000 different ideas, you can focus all your intellectual horsepower on deeply understanding the few things that fall within your domain. This allows you to move from a state of shallow awareness about many things to a state of profound expertise about a few. And in the world of capital allocation, profound expertise is where astronomical returns are born. By forcing yourself to define what you know, you are simultaneously building a wall against the seductive danger of what you don't. It is an active defense against the brain's natural tendency to believe it's smarter than it actually is. So how do you translate this powerful psychological principle into a practical, actionable blueprint for your own investment journey? How does a retail investor, without the resources of a Berkshire Hathaway, build their own circle of competence and identify their personal fat pitches? It's a systematic process of self-inquiry and focused learning. The first step is to conduct a personal intellectual audit. Take out a piece of paper and draw 3 columns. In the first column, list your professional expertise. What industry do you work in? What processes, customers, and economic models do you understand intimately because you live them every day? A software engineer has a massive, inherent advantage in evaluating enterprise software companies. A doctor can analyze a pharmaceutical company's clinical trial data with a sophistication that a Wall Street analyst never could. A logistics manager understands the competitive dynamics of the railroad and trucking industries. Your career is your first, most obvious circle. In the second column, list your deep, genuine passions and hobbies. These are the subjects you read about for fun, the areas where you have accumulated knowledge over years, not for a paycheck, but out of sheer curiosity. Perhaps you're a car enthusiast who understands the automotive supply chain and brand loyalty of different manufacturers. Maybe you're a passionate gamer who can spot trends in the video game industry long before they show up in quarterly reports. This is a rich, often overlooked area of expertise. Peter Lynch, another legendary investor, famously championed this idea of investing in what you know. finding brilliant opportunities at the local mall, or from observing the products his family used. The third column is the most important for exercising the discipline of patience in investing. Title it the too hard pile. This is where you list everything else. Be ruthless. If you can't explain a business's revenue model and competitive advantage to a 10-year-old in 3 minutes, it goes in the too hard pile. Complex banking derivatives, speculative biotech firms, companies with convoluted financial statements, put them all here. This is not a list of bad companies. It is a list of companies that are bad for you to analyze. This act of categorization is liberating. It frees you from the perceived obligation to have an opinion on everything. Once your audit is complete, the next phase is to deepen your circle. Pick 1 or 2 areas from your first 2 columns and commit to becoming a true expert. This is your blueprint for achieving financial freedom. Your goal is not to be a passive observer but an active learner. Set up a reading program. Read the annual reports of every public company in that niche. Read their competitors' reports. Read trade journals. Listen to industry conference calls. Follow the smartest analysts in that sector, not for their stock picks, but for the questions they ask and the metrics they track. Your goal is to know this small patch of the economic world so well that when a fat pitch finally comes along, a market panic that hammers a great company in your sector, or a temporary business stumble that everyone overreacts to, you will recognize it instantly. It will be obvious to you while it is opaque to everyone else. This is how you build a portfolio strategy based on true knowledge, not speculation. The antithesis to this disciplined approach is the path walked by the 99% of investors, a path of intellectual chaos and financial disappointment. It is the path of diversification, a term also coined by Peter Lynch to describe the tendency of investors to buy into businesses they don't understand, ultimately making their portfolios worse. The average investor operates with no defined circle of competence. Their portfolio is not a curated collection of well-understood assets, but a random assortment of story stocks, media darlings, and speculative bets. Their strike zone is, effectively, the entire universe of publicly traded securities, and their primary decision-making tool is the fear of missing out. Consider the dot-com bubble of the late 1990s. This was a masterclass in the disastrous consequences of straying from one circle. Millions of people, from dentists to teachers to retirees, suddenly fancied themselves technology investors. They poured their life savings into companies with no profits, no clear business models, and often no real product. They bought Pets.com or Webvan, not because they had analyzed the brutal economics of last-mile delivery or online pet supply retail, but because the stock chart was going up and their neighbor was getting rich. They couldn't have explained the company's balance sheets or income statements, but they could recite the latest breathless commentary from a TV analyst. They were swinging wildly at pitches they couldn't even see, mesmerized by the speed and the roar of the crowd. When the bubble burst, fortunes were annihilated. It wasn't just money that was lost. It was time, years of savings that could never be recovered. The tragedy is that this was an unforced error. These investors were not compelled to participate. They chose to play a game they didn't understand, and they paid the ultimate price. This behavior isn't a historical artifact. It's a recurring pattern. It reappears in every market cycle. We saw it with the housing bubble in the mid-2000s, with cannabis stocks, with the meme stock craze, and with speculative cryptocurrencies. The pattern is always the same. A compelling narrative captures the public imagination, creating a powerful social proof that draws in capital from those outside their circle of competence. The 99% chase heat, not value. Their process is backward. They start with a conclusion: I need to own this hot stock, and then work backward to find justifications for it. The disciplined investor, the one operating within their circle, does the opposite. They start with a universe of businesses they understand, apply a rigorous set of criteria, and wait patiently for the price to become attractive. The path of the 99% is a frantic search for shortcuts to wealth. The path of the professional is a slow, deliberate process of accumulating knowledge and waiting for that knowledge to intersect with opportunity. The former leads to excitement and eventual ruin. The latter leads to boredom and eventual riches. The direct financial connection between defining a circle of competence and building wealth is concrete and measurable. It manifests directly on your personal balance sheet through two critical concepts: risk reduction and a higher margin of safety. First, let's talk about risk. For most people, risk is volatility. It's the stock price going up and down. For Buffett, true risk is the permanent loss of capital, and the number one source of that risk is not knowing what you are doing. When you invest within your circle, your ability to assess the real business risks is exponentially higher. You can more accurately judge the quality of management, the durability of the company's competitive advantage, and the potential threats on the horizon. Because you understand the landscape, there are fewer unknown variables. A business you understand is a business whose future cash flows are more predictable. And the entire art of value investing, the discipline that underpins all of Buffett's success, is about forecasting future cash flows and buying the business for a significant discount to that future value. You cannot do this with any degree of accuracy outside your circle. This leads directly to the concept of the margin of safety, the cornerstone of Benjamin Graham's philosophy. The margin of safety is the difference between the intrinsic value of a business and the price you pay for it in the market. A wide margin of safety is your protection against bad luck, unforeseen events, and errors in your own judgment. You can only calculate a reliable intrinsic value for a business you deeply understand. For a company outside your circle, any valuation is just a guess, a shot in the dark. But for a business you know inside and out, you can establish a conservative estimate of its worth. You can then demand a steep discount to that worth before you invest. For example, if you analyze a company within your circle and conservatively estimate its value at $100 per share, you might only be willing to buy it if the market price falls to $50 or $60. That $40 to $50 buffer is your margin of safety. It is your built-in shock absorber. The financial consequence of this is profound. It tilts the odds dramatically in your favor. If you are right about the business, you stand to make a massive return as the price moves toward its intrinsic value. If you are wrong, and the business only turns out to be worth $70 per share, you still break even or make a small profit. This is how a professional capital allocator designs a heads I win, tails I don't lose much scenario. This is only possible through the intellectual clarity provided by the circle of competence. It transforms investing from a speculative gamble into a calculated, probability-weighted endeavor, ensuring that your long-term investing journey is built on a foundation of stone, not sand. Now, even when you have meticulously defined your strike zone, an even greater challenge emerges. You know exactly what you're waiting for, that perfect, slow pitch right down the middle. But days turn into weeks, weeks into months, and the pitcher just keeps throwing curveballs. The market is soaring, and you are sitting on cash. Everyone around you is swinging and hitting what look like singles and doubles. The pressure to just do 10-something becomes immense. This brings us to the second great pillar of the fat pitch philosophy: mastering the agony of inaction. The human brain is not wired for patience. It is an action machine, evolved over millennia to react, to move, to solve problems through doing. In the world of investing, this ancient wiring is a catastrophic liability. The ability to sit still, to do nothing with your capital, while others are getting rich, is perhaps the most unnatural and yet most profitable skill an investor can develop. It requires a conscious and deliberate battle against your own instincts, against the very fabric of your psychology. To witness this principle in its most extreme and profitable form, we must look at the period between 1998 and early 2000. The world was in the grips of the dot-com mania. The Nasdaq was a rocket ship, doubling and then tripling in value. Companies with .com in their name were achieving billion-dollar valuations overnight, often with little more than a business plan on a napkin. And what was Warren Buffett, the world's greatest investor, doing? He was doing nothing. Berkshire Hathaway's stock, for the first time in decades, was dramatically underperforming the market. From the summer of 1998 to the spring of 2000, while the Nasdaq soared over 200%, Berkshire Hathaway's stock price actually fell by nearly half. The media narrative was brutal. Barron's ran a cover story in late 1999 titled, "What's Wrong, Warren?" Articles declared him a relic, a dinosaur whose folksy, value-based approach was obsolete in the new digital economy. He, quote, "didn't get it." He was finished. The pressure on him was monumental, not just from the media, but from his own shareholders who were watching their friends get rich on stocks like Qualcomm and Cisco while their Berkshire shares languished. Imagine the psychological fortitude required to withstand that. Every fiber of your being, every external signal is screaming at you that you are wrong. It is one thing to be patient when the market is flat. It is another thing entirely to be patient while you are actively losing money relative to the benchmark and being publicly ridiculed for it. But Buffett did not waver. Why? Because the pitches being thrown were wildly outside his circle of competence. He admitted he couldn't predict which of the hundreds of new internet companies would survive, let alone dominate. More importantly, the prices being asked were not just optimistic, they were ludicrous. There was no margin of safety. He was being asked to pay for decades, even centuries, of hoped-for growth that might never materialize. So he sat. He let the pitches go by. He held billions of dollars in cash, which in a roaring bull market felt like a boat anchor. Then, in March of 2000, the bubble burst. The Nasdaq began a collapse that would wipe out nearly 80% of its value. The high-flying tech stocks vaporized. Fortunes were erased. And Warren Buffett, the dinosaur, was sitting on a mountain of dry powder. That cash was no longer a boat anchor. It was a treasure chest. It was a powerful strategic weapon. In the aftermath of the crash and the subsequent recession, he was able to deploy that capital into wonderful businesses at wonderful prices. He wasn't just a survivor, he was the buyer of last resort, able to name his price when fear gripped the market. This episode is the ultimate testament to the power of inaction. His refusal to play a losing game in 1999 was the very reason he was able to win so decisively in 2001, 2002, and beyond. He mastered the agony of doing nothing, and in doing so preserved the capital and the optionality that would fuel the next decade of Berkshire's growth. The immense difficulty of Buffett's feat during the dot-com bubble can only be understood by dissecting the deep-seated psychological principles that make inaction so painful. The primary culprit is a cognitive bias known as the action bias. On a fundamental evolutionary level, our brains are wired to favor action over inaction, even when inaction is the more rational choice. For our ancestors on the savannah, this made perfect sense. If you heard a rustle in the grass, it was far better to take the action of running away, even if it turned out to be just the wind, than to do nothing and risk being eaten by a lion. The cost of a false positive, running for no reason, was minimal, while the cost of a false negative, not running from a real threat, was fatal. This deep programming equates action with survival and control. In the modern world of investing, this instinct is perverted. The stock market's endless ticker tape is the rustle in the grass. Every news alert, every analyst upgrade or downgrade screams for a reaction. The action bias tells us that doing something, buying, selling, rebalancing, is better than sitting on our hands. It gives us an illusion of control over a chaotic system. Compounding this is the powerful psychological force of the fear of missing out, or FOMO. FOMO is a form of social anxiety, a concern that one might miss out on rewarding experiences that others are having. When you see stories of people making fortunes on a new stock or asset class, your brain's social comparison circuits go into overdrive. It feels like everyone else is at a party that you weren't invited to. This emotion is a powerful motivator for impulsive, irrational decisions. You buy a stock not because you've done the research, but because you can't bear the thought of watching it double without you. Another critical bias at play is loss aversion, the principle discovered by psychologists Daniel Kahneman and Amos Tversky. Their research showed that humans feel the pain of a loss about twice as strongly as they feel the pleasure of an equivalent gain. When the market is rising, holding cash is framed by our brains as a loss. Every percentage point the S&P 500 goes up feels like money you are actively losing. This opportunity cost is perceived with the same emotional intensity as an actual portfolio decline. This makes sitting on the sidelines psychologically excruciating. It takes a supreme act of emotional control to reframe that cash not as a missed gain, but as what it truly is: a call option on future fear, a tool of immense value waiting for the right moment. Mastering the agony of inaction is a direct fight against these three powerful forces: the innate desire for action, the social pain of missing out, and the perceived loss of holding cash. It is the triumph of rational, long-term thinking over primitive, short-term emotion. So how do you, as an individual investor, build the mental armor necessary to win this internal battle? How do you cultivate the profitable art of doing nothing until the odds are overwhelmingly in your favor? The blueprint begins with consciously structuring your information diet. The primary fuel for the action bias and FOMO is the constant stream of financial news and market commentary. You must starve the beast. This means turning off the financial news channels. It means deleting the stock market app from your phone's home screen. It means committing to checking your portfolio on a predetermined, infrequent schedule, perhaps quarterly, or even semi-annually. Your goal is to shift your focus from the daily noise of stock prices to the long-term signal of business value. Replace the time you spent watching market chatter with time spent reading annual reports, industry journals, and business biographies. This changes the very nature of the game you are playing, from a fast-twitch reaction contest to a slow, deliberate study of business. The second tool is to create a decision journal. This is a simple notebook or document where you articulate your thinking, particularly your reasons for time-not-time acting. When you feel the intense urge to buy a hot stock, force yourself to write down the full investment thesis. What is the business model? What is its competitive advantage? What are the key risks? What is a conservative estimate of its intrinsic value? By the time you have gone through this rigorous analytical process, the emotional heat of the moment will have likely dissipated, and you'll be able to see the situation with more clarity. Crucially, also use the journal to document the fat pitches you are waiting for. Write down the names of the wonderful businesses on your watch list and the specific price or market condition under which you would be willing to act. This pre-commitment is incredibly powerful. It changes your mindset from a reactive one, "What should I do today?" to a proactive, patient one, "I am waiting for condition X to occur in company Y." A third practical technique is to implement rules-based triggers for deploying your capital. Instead of relying on gut feel, which is susceptible to emotion, you can use objective metrics to guide your actions. For example, you might decide to only begin deploying significant capital when a broad market index, like the S&P 500, trades below its 200-week moving average, or when the Shiller P/E ratio falls into its lowest quartile. These rules are not for market timing in the traditional sense, but for enforcing investment discipline. They provide a logical, unemotional framework that prevents you from getting swept up in the euphoria of a bull market and gives you the confidence to act decisively when fear takes over. By building this system of information control, pre-commitment, and rules-based action, you create an environment where patience becomes the default setting. You are no longer fighting your own psychology moment to moment. You have built a structure that makes disciplined inaction the path of least resistance. This is the foundation of superior trading psychology and the key to long-term success. The path of the 99% is the polar opposite of this disciplined inaction. It is a path of constant, frenetic, and ultimately self-destructive activity. The archetype of this path is the day trader, the modern retail investor mesmerized by zero-commission trading apps and the gamification of the stock market. Their screen is a kaleidoscope of flashing red and green numbers. Their day is a series of small bets driven by technical patterns, social media hype, and gut feelings. They believe they are being diligent, that their constant monitoring and trading is a form of work that will lead to profits. In reality, they are simply feeding the brokerage industry and the taxman. Every trade generates a potential commission or bid-ask spread cost. Every winning trade held for less than a year generates a short-term capital gains tax liability. which is taxed at a much higher rate than long-term gains. This constant churn, this financial friction, acts as a powerful headwind, making the already difficult task of beating the market nearly impossible. But the costs are not just financial. The constant activity creates a state of perpetual anxiety. The investor is tethered to the screen, their mood rising and falling with the meaningless gyrations of the market. They are not investing in businesses. They are gambling on stock prices. They mistake volatility for opportunity and noise for information. This approach fundamentally misunderstands the nature of wealth creation. Wealth is not built by frantically turning over a portfolio. It is built by owning great businesses and allowing the power of compounding to work its magic over long periods. The hyperactive trader interrupts this process. They might buy a great company, but they sell it after a 20% gain to lock in a small profit, only to watch it go on to become a 10-bagger over the next decade. They are constantly pulling up their saplings to see if the roots are growing, never giving them the chance to mature into mighty oaks. This behavior is not limited to amateurs. It is rampant in the professional world of wealth management and mutual funds. Many fund managers feel immense pressure to appear busy and justify their fees. They know that clients don't want to pay 1% a year for a manager who tells them, "My best idea this year was to do nothing." So they trade. They chase quarterly performance, they window dress their portfolios at the end of each period, and they generate a whirlwind of activity that often does more to enrich their prime brokers than their clients. The path of the 99% is seductive because it feels proactive. It feels like you are in control, but it is the illusion of control. The reality is that by engaging in constant activity, you are ceding control to your emotions, to the market's whims, and to the friction of costs and taxes. It is a game designed for you to lose slowly, a treadmill of action that leads nowhere. The financial connection between mastering inaction and building a fortune is one of the most powerful yet least appreciated equations in finance. It hinges on transforming your perception of cash. The 99% view cash in a portfolio as a cash drag. They see it as a lazy, unproductive asset that is failing to keep up with inflation or the market's returns. During a bull market, this perspective seems correct on the surface. But it is profoundly wrong. The professional capital allocator, the patient hunter, sees cash not as a drag, but as optionality. Cash is not a zero-return asset. It is a zero-risk call option on every asset class in the world. It is the tool that gives you the right, but not the obligation, to purchase assets when they go on sale, and they always, eventually, go on sale. Let's quantify this. Imagine investor A, the active trader, who stays fully invested at all times. They generate a respectable 10% annual return, but their high turnover means 3% of that return is lost to taxes and trading costs, for a net return of 7%. Now consider investor B, the patient waiter. For 4 years, they are 50% in cash, earning nothing on it, while the other 50% of their portfolio, invested in great businesses, earns 10% a year. Their overall portfolio return in those years is just 5%. They are dramatically underperforming investor A. But in the 5th year, the market crashes by 40%. Investor A rides it all the way down. Investor B, however, now deploys their massive cash hoard at the bottom, buying those same great businesses at a 40% discount. The market then recovers over the next year. Investor B's return in that recovery year is astronomical. When you average out their returns over the entire cycle, they have dramatically outperformed the active trader, and they did it with far less stress and risk. This is exactly what Buffett did after the dot-com bust and again during the 2008 financial crisis. In the fall of 2008, as Lehman Brothers collapsed and the global financial system teetered on the brink of abyss, Buffett was the calm at the center of the storm. Panic was everywhere. But for Buffett, the phone started ringing. He wasn't a seller, he was the ultimate buyer. He injected $5 billion into Goldman Sachs and $3 billion into General Electric, not by buying their common stock on the open market, but by negotiating incredibly favorable deals for preferred stock with high dividend yields and valuable warrants. These were deals no one else could get, deals that were only available because he had two things everyone else lacked: cash and a reputation for long-term thinking. That cash, that optionality, which had been a drag on his returns for years, was suddenly the most powerful asset in the world. It allowed him to demand and get terms that all but guaranteed a massive profit. This is the ultimate financial payoff of patience. Inaction preserves your capital and your psychological equilibrium, allowing you to act with immense force and precision when the rest of the world is paralyzed by fear. Once you have defined your strike zone and cultivated the psychological discipline to wait for the pitch, you need a framework to govern how you swing. It's not enough to just wait for a good idea. You must have the conviction to bet heavily when it arrives. This leads us to the third pillar of the fat pitch strategy, the 20-slot punch card. This is a mental model that Buffett has talked about for decades, a powerful device for forcing concentration and selectivity. He asks you to imagine that you have a punch card with only 20 slots on it. Each time you make an investment, you have to punch one of those slots. For the rest of your life, you only get 20 punches. Once they are gone, they are gone. This simple thought experiment fundamentally changes your entire approach to capital allocation. You are no longer looking for a dozen decent ideas. You are looking for a handful of truly magnificent ones. It forces you to treat every investment decision with the gravity it deserves. It is the mechanic that translates the abstract virtue of patience into a concrete, high-conviction portfolio strategy. The quintessential story of this high-conviction approach, of punching a hole in the card with absolute certainty, is Buffett's investment in American Express in the aftermath of the salad oil scandal. In 1963, a company called Allied Crude Vegetable Oil, a major customer of a subsidiary of American Express, was discovered to be a massive fraud. The company had been borrowing money against its inventory of salad oil, which it stored in large tanks in New Jersey. The fraud was simple but brilliant. The tanks were mostly filled with water, with only a few feet of oil floating on top. When the fraud was uncovered, Allied Crude went bankrupt, leaving its creditors, including American Express, on the hook for enormous losses, potentially $60 million, a huge sum for Amex at the time. The market panicked. The prevailing wisdom on Wall Street was that American Express would be ruined. The stock price collapsed, falling by more than 50% in a matter of weeks. It was a classic case of market hysteria, where a problem in one small part of a business was assumed to be fatal to the entire enterprise. This is where Buffett saw a potential fat pitch. While others were selling in a panic, he decided to do his own research, what he called scuttlebutt. He didn't just look at the financial statements. He went out into the real world to see if the scandal was affecting the core, underlying businesses of American Express. He went to restaurants and travel agencies. He talked to merchants and customers. He observed people using American Express travelers' checks and credit cards. What he discovered was that the fundamental value of the franchise was completely intact. Customers still trusted the travelers' checks. Merchants still valued the affluent clientele that the American Express card brought into their stores. The salad oil problem was a fire, but it was a fire contained to one isolated warehouse. The main castle was untouched. He concluded that the company's earning power from its core businesses was strong enough to easily absorb the scandal-related losses. The market was pricing the company for bankruptcy, but the reality was that it was just a temporary, albeit painful, setback. Convinced of his analysis, Buffett didn't just take a small position, he acted with enormous conviction. He invested 40% of his investment partnership's entire capital into American Express stock. This was a massive, career-defining bet. He punched the card, and he punched it hard. Over the next few years, as the market realized the company was not going to fail, the stock price soared. The single decision generated a huge windfall for his partners and cemented his reputation as a brilliant, contrarian investor. It was a perfect execution of the philosophy. He waited for an opportunity born of extreme market fear, did the deep, fundamental research to gain an informational edge, and then, because his conviction was so high, he bet the farm. That is the power of the 20-slot punch card mindset. The psychological principle underpinning the 20-slot punch card is its ability to combat our natural tendency towards overconfidence, while simultaneously demanding a higher standard of earned confidence. The human mind loves to collect things, to diversify its options. In investing, this manifests as a desire to own a little bit of everything. It feels safer. It satisfies our urge to participate in many different stories. But this diversification is often just a mask for a lack of true conviction. If you own 50 stocks, you are admitting that you don't really have a deep understanding of any of them. You are simply hoping that the winners will outweigh the losers. The punch card mental model acts as a powerful constraint that fundamentally improves the quality of your decisions. Constraints are a well-documented catalyst for creativity and rigor. When your options are limited, you are forced to think more deeply and choose more wisely. The punch card's scarcity, only 20 slots for a lifetime, forces you to raise your standards. You are no longer asking, "Is this a good investment?" You are forced to ask, "Is this one of the 20 best investments I will see in my entire life?" This question immediately eliminates 99.9% of all possibilities. It raises the bar to an almost impossibly high level. This process helps to distinguish between a fleeting gut feeling, overconfidence, and a deeply researched, well-articulated thesis, earned confidence. To justify punching a slot, you must have an answer for every conceivable question and every potential risk. You have to understand the business, the industry, the management, and the valuation so thoroughly that the investment becomes, in the words of Charlie Munger, a cinch. This framework also helps to manage portfolio risk in a more intelligent way. The conventional wisdom in modern portfolio theory is that risk is reduced by adding more stocks, by diversifying away company-specific risk. But Buffett and Munger argue that this is backward. For the intelligent investor operating within their circle of competence, risk is decreased by concentrating in a few businesses that you understand profoundly. They argue that it is far riskier to own a small piece of 50 companies you know little about than to own a large piece of 3 companies, you know inside and out. The punch card is the mechanism that enforces this philosophy. It forces you to do the hard work required to gain that deep knowledge. It transforms you from a collector of stocks into a professional capital allocator. It's a mental shift from "I hope this goes up" to "I understand why this is undervalued, and I am willing to bet a significant portion of my capital on that understanding." It is the ultimate tool for achieving high-conviction investing. To apply the punch card model to your own portfolio strategy, you must first embrace its spirit of radical selectivity. The first step is to set your number. While Buffett used 20 as a hypothetical, you might choose 10, 15, or 25, depending on your temperament and the time you can dedicate to research. The exact number is less important than the principle of scarcity it represents. Once you have your number, the next step is to design a rigorous, non-negotiable checklist that any potential investment must pass before it can even be considered for a slot. This is your quality filter. Your checklist should include questions about the business itself. Does it have a durable competitive advantage or moat? Does it have a history of consistent and growing earnings? Does it generate high returns on capital? It should also include questions about management. Are they honest and transparent? Do they have a track record of intelligent capital allocation? Are their interests aligned with shareholders? Finally, it should include questions about price. Is the company trading at a significant discount to your conservative estimate of its intrinsic value? Is there a substantial margin of safety? Only a company that gets a resounding yes to all of these questions can be a candidate for a punch. The third step is to establish rules for position sizing. When an idea is good enough to earn a punch, it should be a meaningful position. A 1% or 2% position doesn't make sense in a punch card world. A typical punch might represent 5%, 10%, or even more of your investment capital. The goal is to make your best ideas have a real impact on your results. The fourth, and perhaps most difficult step, is to define the criteria for 10 punches selling and freeing up a slot. This should be an equally rigorous process. A sale should not be triggered by market volatility or because you've made a certain percentage gain. A slot should only be freed up if your original investment thesis is proven to be wrong, if the company's long-term competitive position has fundamentally deteriorated, or if you have found a new, demonstrably superior opportunity that is so compelling it justifies selling one of your existing high-conviction holdings to fund it. This systematic approach, a fixed number of slots, a rigorous quality checklist, meaningful position sizing, and strict selling discipline, transforms the punch card from a folksy analogy into a powerful operational framework for beating the market over the long term. The antithesis of the punch card philosophy, the path followed by the vast majority, is one of timid over-diversification and outsourcing of thought. At one extreme, you have the index fund absolutist. While indexing is a perfectly sensible strategy for those who have no interest in studying businesses, it is, by definition, a strategy that guarantees average returns. You are buying every stock in the market, the good, the bad, and the ugly. You are guaranteed to own the next great winner, but its impact on your portfolio will be diluted to near irrelevance by the hundreds of mediocre or failing companies you are also forced to own. You have traded the possibility of exceptional returns for the certainty of mediocrity. At the other extreme is the over-diversified individual stock picker. This is the investor who proudly proclaims they own 60 different stocks. Their portfolio is a chaotic menagerie of small positions, a financial zoo where no single animal is large enough to be meaningful. They have a 1% position in a tech stock, a 0.5% position in a consumer staple, a 1.5% position in a bank. Even if one of their picks turns out to be a spectacular success and goes up 10 times, its impact on their overall net worth is negligible. A 10x return on a 1% position only adds 9% to the total portfolio value. It's a huge analytical success that results in a minor financial victory. This is not a strategy for building wealth, it is a strategy for feeling busy. This phenomenon is also rampant in the professional mutual fund industry, where it's known as closet indexing. A fund manager might own 100 or 200 stocks. While they claim to be active stock pickers, their portfolio looks so much like the benchmark index that their returns, before their high fees are deducted, are almost indistinguishable from it. They do this out of career risk. If they concentrate in a few names and are wrong, they could lose their job. It is far safer for their career to look like everyone else and deliver average performance. The result for the investor is the worst of both worlds. They get index-like returns but pay the high fees of active management. The path of the 99% is built on a misunderstanding of risk. They believe that owning more things makes them safer. But by spreading their capital so thinly, they ensure that their great decisions will have as little impact as their bad ones. They have diversified away not just risk but also the very possibility of outstanding returns. They have constructed a portfolio that is mathematically engineered for mediocrity. The direct financial connection of the punch card philosophy is the simple but profound mathematics of concentration. This is how high-conviction investing directly translates into superior long-term results and eventual financial freedom. Let's run a simple, powerful comparison. Consider two investors, both starting with a $100,000 portfolio. Investor A is the diversifier. They own 50 stocks with a 2% allocation to each. Investor B is the concentrator, following a 10-slot punch card model. They own 10 stocks with a 10% allocation to each. Now, let's say both investors are equally skilled and are able to find one 10-bagger, a stock that increases in value by 10x over the next decade. For investor A, their 2% position, which was $2,000, grows to $20,000. It's a gain of $18,000. their total portfolio value grows from $100,000 to $118,000 from this one great decision, assuming all other stocks stay flat. It's a nice gain, but it's not life-changing. Now look at investor B. Their 10% position, which was $10,000, also grows 10x to $100,000. It's a gain of $90,000. Their total portfolio value grows from $100,000 to $190,000 from that single decision. One great idea has almost doubled their entire net worth. This is the engine of wealth creation. Beating the market over the long term is not about being right 55% of the time on 100 different bets. It is about being spectacularly right a few times and making sure those few times count. The mathematical reality is that portfolio returns are not driven by the average of all your decisions. They are driven by the outliers, the handful of massive winners. A concentrated portfolio strategy is designed to maximize the impact of those winners. It is a recognition that great ideas are rare, and when one comes along, it should be exploited to the fullest. This approach has a dramatic impact on your long-term compound annual growth rate, CAGR. The difference between compounding your capital at 12% per year versus 18% per year might seem small, but over a 30-year investment horizon, the results are staggering. A $100,000 investment growing at 12% becomes just under $3 million. At 18%, it becomes over $14 million. That difference, that $11 million of additional wealth, is created by having the discipline and conviction to make your best ideas matter. The 20-slot punch card is not just a clever analogy, it is a mathematical formula for transforming a handful of brilliant insights into a lifetime of financial independence. Even with a defined strike zone, the fortitude for inaction, and a framework for high-conviction betting, there is one final formidable obstacle: the siren song of the crowd. The market is not a sterile, rational environment. It is a swirling vortex of human emotion, a cacophony of narratives, opinions, and predictions. Every day, you are bombarded with noise, from financial news anchors breathlessly reporting on the day's trivial movements, from Wall Street analysts upgrading and downgrading stocks, from social media gurus promising the next big thing. This constant stream of information is designed to provoke a reaction, to pull you into the herd. Resisting this immense social pressure, this tyranny of market noise, is the fourth pillar of the fat pitch philosophy. The greatest investment opportunities are almost never the most popular ones. They are found in the lonely, neglected, or even hated corners of the market. To capitalize on them, you must be willing to stand apart from the crowd, to think independently, and to trust your own analysis, even when it is deeply unpopular. A powerful illustration of this principle is Buffett's investment in the Washington Post in the early 1970s. At the time, the Washington Post Company was a deeply out-of-favor stock. The company had recently gone public, and its share price had been hammered. The market was terrified of several factors. There was political risk. The paper, through its reporting on the Pentagon Papers and the burgeoning Watergate scandal, was making powerful enemies in the Nixon administration, who were threatening the renewal of its valuable television station licenses. There was labor risk. The company was facing contentious union negotiations. And there was general market pessimism. The country was entering a period of stagflation and uncertainty. The prevailing narrative on Wall Street was that newspaper stocks were a terrible investment, and the Washington Post in particular was toxic. The crowd wanted nothing to do with it. Buffett, insulated in his office in Omaha, ignored the noise. He did what he always does. He read the company's financials and thought about the underlying business. What he saw was not a politically risky entity on the verge of collapse, but a magnificent economic franchise trading at a ridiculously cheap price. The entire company had a market capitalization of around $80 million. Buffett did a quick, conservative valuation of its assets. He figured the company's television stations were worth at least $100 million, its newspaper properties were worth far more, and it also owned Newsweek magazine and other valuable assets. He estimated the private market value of the company was at least $400 million, and probably more. The market was offering him the chance to buy a dollar bill for 20 cents. He understood the local monopoly that a dominant newspaper held in the pre-internet era. It was the essential source of news, classified ads, and retail advertising. It was a toll bridge for local commerce. The political noise, while scary, was temporary. The economic moat was deep and durable. So, from 1973 to 1974, as the market continued to panic, Buffett's firm, Berkshire Hathaway, quietly accumulated over 10% of the company's stock, becoming its largest outside shareholder. He paid about $11 million for his stake. That single investment, made when the crowd was screaming "sell," would become one of the most successful in Berkshire's history. Over the next 3 decades, that $11 million purchase compounded into a holding worth well over $1 billion, a hundredfold return. This financial masterpiece was only possible because Buffett had the ability to completely tune out the deafening roar of the crowd and focus solely on the long-term value of the business. The psychological force that makes ignoring the crowd so difficult is our deep-seated need for social proof and our innate herd mentality. As social creatures, we are wired to find safety and validation in numbers. For millennia, conforming to the group was a survival strategy. The individual who wandered off from the tribe was far more likely to be eaten by a predator. This instinct is still powerfully active within our brains. When we see a large group of people doing something, whether it's rushing for an exit, buying a popular product, or selling a stock, our immediate subconscious reaction is that they must know something we don't. We feel a powerful urge to conform. The famous Asch conformity experiments of the 1950s demonstrated this beautifully. In these studies, a subject was placed in a room with a group of actors and asked to perform a simple visual perception task. The actors were instructed to give unanimously incorrect answers. A shockingly high percentage of the subjects, despite knowing the correct answer, would go along with the group's incorrect choice, simply to avoid the discomfort of standing alone. The stock market is a giant global Asch experiment conducted every single day. When a stock's price is soaring, it creates a powerful social proof that buying is the right decision. When a stock is crashing, the plunging price is a signal that selling is the wise thing to do. This herd behavior is the engine of bubbles and crashes. Bubbles form as a feedback loop of rising prices, and positive narratives draw more and more people in, not based on fundamental value but on the fear of missing out on easy gains. Crashes happen when the loop reverses, and falling prices and negative narratives create a panic-driven stampede for the exits. The disciplined investor must consciously fight this instinct. They must cultivate a mindset of radical independence. As Buffett has famously said, you must be fearful when others are greedy, and greedy when others are fearful. This is not just a clever aphorism, it is a direct instruction to short-circuit your brain's herding instinct. It requires the emotional fortitude to feel the discomfort of being in the minority, to buy when your friends and neighbors are panicking, and to sell or sit in cash when they are euphoric. It is the understanding that in investing, the crowd is almost always wrong at the most important turning points. Building an insulation strategy to protect yourself from the tyranny of the crowd is an active, ongoing process. The first and most critical step is to curate your inputs. The fire hose of information from financial media and social media is the primary transmission vector for herd mentality. You must replace it with better sources. Your goal is to shift your information diet from opinions to facts. This means dramatically reducing your exposure to CNBC, Bloomberg TV, and other outlets focused on short-term market commentary. Instead, spend that time reading primary source documents, company annual reports, the 10 kilo-second, investor presentations, and quarterly earnings call transcripts. These are the raw materials of serious analysis. They are often dry and boring, which is a feature, not a bug. They lack the emotional hype of a TV segment and force you to engage in slow, critical thinking. Create a curated list of thinkers and writers who exhibit genuine independent thought, not just those who parrot the consensus. The second component of your insulation strategy is to find what Munger calls a rationality partner. This is someone you trust, who is also grounded in the principles of long-term business-focused investing, with whom you can discuss your ideas. The purpose of this partner is not to validate your conclusions, but to challenge them. They are there to poke holes in your thesis, to force you to defend your reasoning, and to point out potential biases in your thinking. This creates a crucial check against falling in love with your own ideas or getting swept up in a popular narrative. If you don't have such a person in your life, you can simulate one by actively seeking out the most intelligent bearish argument against your investment thesis. Force yourself to read it, understand it, and write a rebuttal. If you cannot dismantle the bear case, you have no business owning the stock. A third powerful mental tool is to adopt what I call the time traveler perspective. Before making any investment decision, ask yourself, 10 years from now, what will I wish I had done in this moment? This simple question instantly lifts you out of the short-term emotional fray. The daily noise, the quarterly earnings miss, the scary headline, they all shrink in significance when viewed through a decade-long lens. It forces you to focus on the things that truly matter for long-term value creation. The durability of the company's competitive advantage, the quality of its management, and the long-term growth prospects of its industry. By systematically applying these techniques, curating your inputs, finding a rationality partner, and using a long-term mental framework, you can build a psychological fortress that allows you to operate with clarity and calm while the rest of the market is lost in the fog of the crowd. This is the essence of building true investment discipline. The antithesis to this independent mindset is the thematic investor. This is the person whose entire portfolio strategy is built on chasing the latest popular narrative. They don't buy businesses, they buy stories. In the late 1990s, they bought the internet theme. In the mid-2000s, it was the BRICs, Brazil, Russia, India, China theme. More recently, they have chased themes like disruptive innovation, cannabis legalization, the metaverse, or artificial intelligence. Their process usually involves buying an ETF that is explicitly designed to track one of these themes or a handful of the most popular stocks associated with it. This approach is seductive because it feels smart and forward-looking. It allows the investor to feel like they are part of the next big thing. But it is an intellectual trap. Thematic investing is dangerous because by the time a theme is popular enough to have ETFs created around it and be on the cover of magazines, the investment opportunity is almost always already gone. The narrative has attracted so much capital that the valuations of the underlying companies have been bid up to astronomical levels. The future growth, and much more, is already priced in. The thematic investor is, by definition, arriving late to the party. They are providing the exit liquidity for the early, smart money investors who identified the trend years before it became a theme. The disastrous performance of many thematic funds, like the ARK Innovation ETF after its peak in early 2021, is a testament to this reality. Investors who piled in at the top, captivated by the story of disruptive innovation, suffered catastrophic losses as the narrative unraveled and valuations reverted to more sane levels. The thematic investor has outsourced their thinking to the marketing departments of asset management firms. They have allowed the crowd to pick their stocks for them. This is the polar opposite of the independent, bottom-up analysis practiced by Buffett. It is a strategy built on hope and hype, and it almost inevitably leads to buying high and selling low. The direct financial connection between resisting the crowd and superior returns lies in the fundamental equation of value investing. Price is what you pay, value is what you get. The constant noise of the crowd, the narratives, the fear, and the greed, all of these things have a powerful effect on a stock's price. They can cause a stock's price to deviate wildly, in both directions, from the underlying value of the business. This disconnect is the sole source of opportunity for a rational investor. By ignoring the crowd, you free yourself to focus on the only thing that matters in the long run: the intrinsic value of the business. You can conduct your analysis with a clear head, unswayed by the emotional tides of the market. This allows you to identify and exploit the mispricings that the crowd creates. When the crowd is euphoric about a particular stock or sector, its collective buying pushes the price far above the underlying value. The independent thinker recognizes this and avoids it, or even sells into the strength. This protects their capital from the inevitable crash that follows when reality sets in. More importantly, when the crowd is panicking about a stock, a sector, or the entire market, its collective selling pushes the price far below the underlying value. This is the moment the patient, independent investor has been waiting for. This is the fat pitch. The ability to be greedy when others are fearful means having the analytical clarity and emotional fortitude to buy assets for 50, 40, or even 30 cents on the dollar. Every dollar of wealth Buffett has ever created was born from such a disconnect. His purchase of the Washington Post, American Express, Coca-Cola after the 1987 crash, his investments during the 2008 crisis, they were all purchases of wonderful businesses whose prices were temporarily depressed by an irrational and fearful crowd. Your immunity to the herd mentality is directly proportional to your ability to find these extraordinary bargains. It is the single greatest determinant of whether you will achieve average market returns or build a truly market-beating, wealth-generating portfolio over your lifetime. We have now arrived at the final pillar, the grand culmination of our entire philosophy. We have defined our strike zone, we have developed the discipline to wait for the pitch, we have a framework for swinging with conviction, and we have built a fortress against the noise of the crowd. The fifth and final pillar is the ultimate payoff: understanding and harnessing the compounding power of patience. This is where the magic happens. This is how a few, infrequent but great decisions, followed by long periods of patient inaction, build not just wealth but generational wealth. It is the recognition that the most powerful force in the financial universe is compound interest, and the greatest catalyst for that force is time. The hyperactive trader is constantly interrupting this process. The patient investor, the one who makes a great decision and then has the discipline to sit on their hands for decades, allows the eighth wonder of the world to work its uninterrupted magic. There is no better story to illustrate this principle than Warren Buffett's investment in the Coca-Cola Company. The year was 1988. The stock market was still reeling from the Black Monday crash of October 1987, when the Dow Jones Industrial Average fell by over 22% in a single day. Fear was still palpable. But in Omaha, Buffett saw an opportunity. He saw one of the most powerful, dominant brands in the history of capitalism trading at a reasonable price. For years, he had admired Coca-Cola. He was a customer, famously drinking 5 Cokes a day. But more than that, he understood its business model with perfect clarity. It was a simple product with global brand recognition. Its secret formula was a powerful moat, but its true competitive advantage was what he called the share of mind it occupied in billions of consumers around the globe. When someone thought of a refreshing drink, they thought of Coke. This was a fortress that no competitor could easily assail. He saw a business that required very little capital to grow, that had immense pricing power, and that was expanding into new international markets. After the crash had made its valuation attractive, he didn't just nibble. He acted with the conviction that our third pillar demands. Over a period of about 7 months in 1988 and 1989, Berkshire Hathaway invested over $1 billion to acquire a major stake in Coca-Cola, making it the largest single common stock investment in their portfolio. It was a massive punch in the punch card. And then he did the most important thing of all. He did nothing. For years, for decades, he didn't trade around the position. He didn't sell after it doubled. He didn't get scared out during recessions or market panics. He simply held on, allowing the company to continue growing its earnings, raising its dividend, and repurchasing its stock year after year. Let's trace the power of that one decision, followed by decades of patience. That initial $1 billion investment has grown in value to over $25 billion today. But that's only part of the story. Along the way, Berkshire has received billions upon billions of dollars in dividends. The annual dividend Berkshire now receives from its Coke stock is more than half of its entire original investment. They get their initial purchase price back every 2 years, just in dividends. This is the incredible power of uninterrupted compounding. That single brilliant decision in 1988, followed by 35 years of sitting still, has created a financial gusher that has funded countless other investments and contributed massively to the wealth of Berkshire shareholders. It is the ultimate proof that wealth is not created in the buying or the selling, but in the waiting. It is the physical manifestation of how one fat pitch, hit with conviction and given decades to travel, can land you in the Financial Hall of Fame. The psychological barrier that prevents most people from achieving this kind of result is a powerful cognitive bias known as hyperbolic discounting. This is our brain's innate tendency to prefer smaller, immediate rewards over larger, delayed rewards. The closer a reward is in time, the more value we place on it. It's why people choose to receive $50 today over $100 a year from now, even though the latter is an objectively better financial choice. It's why we eat the donut now instead of sticking to the diet that will give us better health in the long run. Our brains are wired for instant gratification. In investing, this bias is a portfolio killer. It's the voice in your head that tells you to lock in a profit after a stock has gone up 30%. The immediate pleasure of realizing that gain is far more seductive to our brain than the abstract, distant promise of a much larger gain years down the road. Hyperbolic discounting is why people constantly check their portfolios. Each small green number provides a little dopamine hit, a tiny immediate reward. It's also why they sell their winners and hold on to their losers. Selling a loser means realizing a loss, which is an immediate pain. Holding on to it preserves the hope of a future gain, deferring the pain. Selling a winner provides an immediate pleasure, while holding on to it carries the risk of that pleasure being taken away if the stock goes down. This entire pattern of behavior, driven by our brain's desire for immediate emotional reward and avoidance of immediate emotional pain, is the exact opposite of what is required for successful long-term investing. The compounding power of patience requires you to override this deep-seated programming. It demands that you sacrifice the small, immediate pleasure of taking a quick profit for the much larger but much more distant reward of true wealth creation. It is a battle between your impulsive, emotional lizard brain and your rational, long-term planning prefrontal cortex. Winning this battle is the final key to unlocking extraordinary financial success. So how do you build a practical system for long-term holding and harness the power of compounding? The first step is a fundamental shift in your time frame. When you buy a stock, your default mindset should not be, "When will I sell this?" but rather, "I intend to hold this business forever, unless something fundamentally breaks." This buy-to-hold forever mentality forces a much higher standard of quality on your purchase decisions. You are no longer renting a stock, you are buying a piece of a business that you intend to be your partner for life. This immediately eliminates mediocre companies and short-term trades from your consideration. The second step is to focus intensely on the quality and integrity of management. If you are going to be a partner with a business for decades, you must have absolute trust in the people running it. You need to study their track record of capital allocation. Do they reinvest profits wisely to grow the business? Do they return excess capital to shareholders through intelligent buybacks and dividends? Or do they squander it on overpriced, ego-driven acquisitions? Long-term compounding is only possible with excellent management at the helm. The third component of this system is to build what Charlie Munger calls a latticework of mental models. This is a collection of concepts from different disciplines, psychology, economics, history, physics, that you can use to periodically reevaluate your investment thesis. The goal is not to react to daily news, but to have a robust framework for assessing whether the long-term competitive advantage of your business is still intact. For example, once a year you might review your holdings and ask, has anything changed about this company's moat? Has technology created a new threat? Has the management team's behavior changed? This is a slow, deliberate process of re-underwriting the loan of your capital, not a reaction to the stock price. Finally, you must structure your personal finances to ensure you are never a forced seller. This means avoiding the use of leverage or margin loans. It means having an adequate emergency fund in cash so that a personal financial crisis doesn't force you to sell your valuable long-term holdings at the worst possible time. By adopting a forever timeframe, focusing on management, using mental models for periodic review, and ensuring your financial stability, you create the perfect environment for the magic of compounding to take root and flourish. The antithesis of this patient, long-term approach is the investor who lives by the seemingly wise but ultimately wealth-destroying aphorism, "You can't go broke taking a profit." This is the philosophy of the profit taker. On the surface, it sounds prudent. It speaks to a sense of caution and risk management, but in practice, it is a recipe for mediocrity. The profit taker is the investor who buys a wonderful business, watches it appreciate by 50%, and then sells to lock it in. They have turned a potentially life-changing investment into a modest, short-term gain. The fundamental flaw in this thinking is that it treats all investments as if they are of equal quality. It fails to recognize that true 10-baggers, the kind of companies that can compound wealth for decades, are incredibly rare. When you are lucky enough to find one, the single worst thing you can do is sell it. This philosophy leads to a disastrous portfolio management strategy that Peter Lynch famously called cutting the flowers and watering the weeds. The investor sells their big winners, the flowers in their portfolio, to lock in small gains. They then hold on to their losing investments, the weeds, hoping they will get back to even. Over time, their portfolio becomes a garden composed entirely of weeds. They have systematically eliminated their best ideas and concentrated their capital in their worst ones. This is a mathematically guaranteed path to underperformance. The great fortunes in investing are not built by stringing together a series of small 20% or 30% gains. They are built by owning a few extraordinary businesses for a very, very long time. Selling your winners prematurely is the cardinal sin of long-term investing. It is the act of interrupting the miracle of compound interest right as it is beginning to get powerful. The profit taker feels smart in the short term, but in the long term, they are sacrificing a forest of future wealth for a few logs of firewood today. The direct financial connection, the ultimate mathematical proof of this entire philosophy, lies in a multi-decade comparison that reveals the devastating impact of taxes and the unappreciated power of uninterrupted compounding. Let's create two investors, both starting with $100,000. Investor A is the skilled trader. They are very good, generating a 20% pre-tax return each year by actively trading. However, because they sell their winners every year, all of their gains are short-term and are taxed at a high 40% rate, federal and state combined. Their 20% gain becomes a 12% after-tax return. Investor B is the patient owner. They follow the fat pitch philosophy. They buy a single, wonderful business and do nothing. Their business also grows at a rate of 20% per year, but since they never sell, they trigger no taxes. Their return is a pure, untaxed 20%. Let's look at the results after 30 years. Investor A, the skilled trader, compounding their capital at a 12% after-tax rate, turns their initial $100,000 into a very respectable $2,995, $992. They have become a multimillionaire. But now look at Investor B, the patient owner. Their $100,000, compounding at an uninterrupted, untaxed 20% per year, grows to a staggering $23, $737, $631. That is nearly $24 million. They have almost 8 times more wealth than the skilled trader, despite starting with the same amount of capital and investing in assets with the same underlying growth rate. The enormous difference is the result of two factors: the devastating, cumulative effect of annual taxes paid by the trader, and the explosive, exponential power of uninterrupted compounding enjoyed by the owner. The trader was constantly draining the tank to pay taxes, while the owner allowed their capital to grow in a tax-deferred cocoon. This is the ultimate financial prize for patience. It is not just a little better, it is a life-altering, dynasty-building difference. This is the final promise of the fat pitch philosophy. By learning to wait, by swinging big at the rare and obvious opportunity, and by then having the fortitude to do nothing, you are not just adopting a clever market strategy. You are harnessing the most powerful mathematical force in the universe and putting it to work for you, creating a future of true and lasting financial freedom. You have just invested something far more valuable than money. You have invested your time and your attention to acquire a powerful new mental tool. You have moved beyond the noise and the hype that dominates the financial world and have grasped a principle of profound importance: that in the game of long-term wealth creation, activity is the enemy, and patience is your ultimate weapon. You now possess the framework used by the world's greatest capital allocator to turn inaction into a strategic advantage, to transform the agony of waiting into the engine of compounding. This is not just theory, it is a practical blueprint for making fewer, better decisions, the kind of decisions that truly shape a financial destiny. But this understanding, as powerful as it is a single crucial piece of a much larger puzzle. The genius of the Buffett and Munger approach is not a single trick, but a network of interconnected mental models, a latticework of wisdom where each concept supports and strengthens the others. You have just mastered the art of waiting for the perfect opportunity, the what and the when. But this is inextricably linked to the art of valuation, the how much. It's connected to the deep analysis of competitive advantages, the why, and it's reinforced by a specific set of psychological disciplines for managing fear and greed. The model you have just learned is the engine, but an engine needs a chassis, a steering wheel, and a skilled driver to reach its destination. The video that is now appearing on your screen is not a random suggestion. Think of it as the next piece of the map. It is the crucial link that connects the principle of patience you've just mastered to another, equally vital component of this intellectual arsenal. It holds the key to the next step in building out your own latticework of models. Clicking on it is not about passively watching another video. It is an active decision. It is a choice to continue your ascent, to add another layer to your understanding, to complete the mental toolkit required to think, act, and invest like the best in the world. The question is no longer whether you have the patience to wait for the fat pitch. The question is whether you have the ambition to acquire the full set of tools needed to recognize it and the courage to swing when it arrives. Continue the journey. Complete the arsenal. Click and discover the missing link.